Has Mr. Prithviraj also joined?
Charan sir, Raman Agrawal, Mr. Raman Agrawal will not join, sir.
He will not join.
No, he will not join.
But
He's having some meeting, so he said, I'm not able.
Okay, fine. I was thinking he will join. He especially mentioned to me.
But now he's saying, I think still he waiting for your approval. Then I said, now we have got the approval, so please join. Then he said, I have another meeting, so I'm not in position to join.
Okay.
Am I audible? Yeah, good evening, everyone. Am I audible?
Yes.
Yes. Thank you.
We can start now. Dr. Rajesh, if you agree, we can start now.
Yes, sir. We should. Sure. I request Shashi Agarwal, sir, please start with your welcome address, sir.
Thank you. Good evening, everyone. First of all, I would like to congratulate ASSOCHAM for holding this seminar, Shadow Monetary Policy Committee meeting, discussion on monetary policy. And the partner also EGROW Foundation.
Hi, Charan.
Yeah. So they deserve congratulations because they are holding this meeting bi-monthly, and very good input usually concluded and we forwarded to the RBI. So it's my privilege to deliver welcome address and opening remarks.
Yes, did you find out? What did you find out?
Okay. So first of all, I would like to welcome Dr. Surjit Bhalla, who is former Executive Director, India International Monetary Fund. So he is chairing the session, and we have panelist Miss Upasana Bhardwaj, Chief Economics, Kotak Mahindra Bank. We welcome you, Madam. Sri Indranail Sen Gupta, Head of Research, CLSA India. Sri Abhi Barua, Chief Economics and Executive Vice President, HFT Bank. Sri Siddharth Sanyal, Chief Economist and Head of Research, Bandhan Bank. Sri Arjun G. Nagarajan, Chief Economist and Communication Manager, Sundaram Asset Management Company Limited. And of course, Dr. Charan Singh, who is committee member of ASSOCHAM National Council for Banking and Chief Executive EGROW Foundation. And also with us, Sri Basudev Mukherjee, Assistant Secretary General, ASSOCHAM. So it's a great pleasure. You see, the Monetary Policy Committee meeting is going to held from 6th to June to 8 June, and they are having the challenge. Last time in the last meeting in April, interest rate has been posed at, it has been capped at 6.5% repo rate. So again, there is a challenge whether it, to keep the interest rate at pause, considering international Federal Reserve. There we have seen that banking industry, certain banks has been failed, and due to increase in interest rate, and there are challenges in growth in US, and their economy is feeling a recession type of situation. So RBI is having a challenge if because if they increase the interest rate, then considering here that inflows should not, with inflows which are coming today should not be out. So that will be a challenge. And one more challenge is growth, which is RBI has to keep the balance between growth and inflation. Though in April, CPI inflation has reduced to 4.7%. WPI wholesale price index, which is in negative now in minus 0.92, lower than in the March 1.34% WPI. So in inflation side, inflation is in India is reasonably softened and within the tolerance limit 4 to 6%. And as it has been predicted that financial year 23-24 CPI inflation should be around 5.2%. We have seen the Q4 data, GDP rate is 6.1%, and financial year 22-23 GDP is around 7.2%, which is comfortable, better than the average. And we are expecting a GDP more than 6% in this financial year 23-24, which has been predicted by various credit rating agencies as well as RBI. So, and we have seen GST collection in May is 1,57,000 crore. So domestic industries is showing positive indications. So I think RBI is not having big challenge to not to increase the rate, keep at 6.5%. I think before 30th September 2023, RBI should not increase the rate. That is my view. And I would like to listen the views of all the experts, all the good experts, panelists. So I conclude my remarks here. Once again, I welcome and to all the panelists and Dr. Surjit Bhallaji to chairing the session, Dr. Charanjit Singh, and everyone in the panel, and all the audience which are sitting here. Without you, no seminar can be completed. So once again, I welcome you all. Thank you very much. Over to Dr. Charan Singh.
I thank you so much, Agrawal ji, for giving us the industry view. And from your industry view, I understand that you're looking for a pause, and that's what your views are reflecting. And we are going to close again with one industry review, which we will get towards the end. And Dr. Rajesh, do we take over as the EGROW, or you have somebody else from the industry coming and speaking to us?
Yes.
Dr.
No,
Rajesh?
sir. Yes, sir. I think, as we discussed earlier, sir, first let us we will listen to the committee member view,
Sure.
then our industry people.
Then
will
we
listen.
go to the industry. Okay,
Yes.
I just want another little, I know Abhi is very busy. Abhi, would you be with us for a few minutes, or you're very short of time and you would like to start?
No, Charan, why don't you go ahead and you can as the I think you usually go first, so why don't you finish your bit, and then maybe if Indranil allows me, I'll just pitch in, and then because usually we go Indranil first and then me.
Yeah.
But if
Yeah.
we can just switch places, I'm extremely sorry. I have to sort of get back to a meeting. If it's okay with everyone, then I would like to go after you.
Sure.
Indranil, would you be
Indranil
okay
is
with
looking
that?
very grumpy, but
Of course.
I am.
Well, the global scene is grumpy, but the Indian scene is very good. So let me do one thing. As Dr. Bhalla requested, Dr. Bhalla will come towards the end. And from as far as the committee members are concerned, Dr. Bhalla would like to be the last, so we'll bring him at the end. I'll give a brief introduction as I always do, and then I'll invite Abhi to present his views, followed with Indranil. Then we'll go to Siddharth, then we'll go to Arjun, and then we will request Dr. Bhalla. And before we close, there is an industry view which is coming in, which I would like to invite. So let me just say at the outset, I think it's time for the pause button at the RBI. If you look at what has happened in the growth story, partly which Mr. Agarwal has just mentioned, we have had an excellent results on 31st May from the GDP data which has been released. I think this is an excellent performance, much more than many of us had really expected. As you know, most of the forecasts were that GDP would grow in Q4 by about 5% maximum, and it exceeded everybody's expectation and it grew by 6.1%. I think that's very impressive. Even if you look at the data and the components where the increase has taken place, it is there in agriculture, it is there in manufacturing, construction, trade, real estate. That means it's very widespread and very balanced. If you look at the end of the complete fiscal year, that's also is very good. If Q4 has performed so well, obviously it gets captured in the annual performance. And in the annual performance, expectation was it will grow by about 7. It has finally increased by 7.2%, which is also beyond the expectation. And then agriculture and real sector has done very well there. I found that the capital formation, which is there, government fixed capital formation, is doing very well. And that is also futuristic and has multiplier effect, and therefore we should look at the spillover of growth into the next year onwards. Agriculture, the data which has been released recently shows there's record production in terms of rice and wheat, maize, oilseeds, sugarcane, mustard and rapeseed, and soybean. So that means the agriculture sector record performance just concluded shows that there is robustness in the economy. And of course, if El Nino does not impact us, going forward, we should record a very good agriculture production too. Now, if we look at IIP and industrial production, I think again the same thing is emerging very clearly. Towards the end, there is an improvement in manufacturing, especially mining and manufacturing. And in manufacturing, motor vehicles, transport equipment, beverages, chemical products are doing very well. In general, capital goods are outperforming others. And again, when it's capital goods, the feeling is always there that this has a multiplier effect and will spill over. Looking at the core industries, except crude, all of them have done very well. Coal, fertilizer, steel, electricity, they're really around 8% growth, and I thought that's very positive. On the fiscal front, the economy is doing again very well. look at the GST collections in May, they are 1.6 lakh crore, which is, I think, a very robust number, 12% over the previous year. And I think that's very high. And total revenue receipts are 1.7 lakh crore, whereas total expenditure, revenue expenditure of the government is 3.1 lakh crore. One is revenue receipts are 6.3% of the annual. I thought that's reasonable, and 6.8% is the expenditure. So it's a very smooth flow of expenditure that has taken place. I also wanted to speak about the Purchasing Managers Index in manufacturing. In May, it is very high, 58.7 as compared to 57.2 in April. And rate of expansion of stock purchases is highest in 12 years. Shows that the economy is in a very robust cycle. Exports are doing well too. And if we look at PMI in services, again, the data that I have is for April, it is 62.0 compared to 57.8, which is again high, basically because of finance and insurance. And if we look at PMI output, private sector, it's 61.6 in April compared to 58.4 in March. So the performance on different sectors is doing very well. Exports are doing again good. In April, they have increased to 65 billion from 63.75 in April 2022. Imports are low, 66.4 there. That means there's going to be a correction. And this is exports plus trade plus services, which is very good. $66.4 billion are the imports vis-a-vis 72.1 last April. So therein, I think current account deficit correction is going to be taking place. On unemployment, yes, little slight CMI data looking at urban rural, but if you look at total, there's a slight uptick. So that is the April data. Global trend, as far as prices are concerned, just mentioned by Mr. Agrawal, but there is, if we look at all the prices, be it WPI, CPI, CPI industrial workers, CPI rural and agriculture laborers, in all cases, there's moderation of inflation. The CPI data on food is around 3.8 now, I think, which is reasonably under control. At the end of the day, the target is 4 ± 2, and at 3.8, I think it's just hitting the target. As far as WPI is concerned, we all agree that the figures show that it's a very big hit, and the inflation figures are very, very low as far as food and general WPI is concerned. In this scenario, internationally, the crude oil has adjusted. It's just around $68 a barrel, down from, as you know, $103 a barrel last year, same time. And if you look at gold, it's gone up little high, and gold always goes up when there is uncertainty. US Fed is correcting its or controlling its hikes, moderating it. So is the story in UK and Euro. So I think India has to take a lesson from there. When it comes to prospects looking forward, as you know, that the geoeconomic situation isn't improving. Russia-Ukraine war is going on. The debt ceiling debate that has happened in front of our eyes in the US, with non-defense expenditure may be controlled, but defense expenditure is not going to be controlled. And there's going to be interrelationships between the two. And therefore, the war continues. I'm sure the deficits in America are going to widen. And given the latest research which IMF is doing, where it is trying to show that the fiscal deficits of the government, they go and financing to a great extent the demand side of the story by their doles and whatever assistance and social security that they provide, they're finding a positive relationship with inflation. And if gross fiscal deficit of America is going to go the way it is, almost visible from the debt ceiling debate, it's obviously going to be inflationary. If geoeconomic situations continue and climate situations continue the way they are, I at least don't see inflation correction taking place in the advanced countries immediately until they start thinking and getting accommodating to the inflation above the 2% figure, and they say, okay, the new normal or at least the new normal for difficult times is 4%, and then they start moderating. So my feeling is that the interest rate corrections may not be that aggressive, but we need not follow it. There may be some positivity in their interest rate changes. Initially, we were thinking there's going to be a stop and then there's going to be adjustment downwards. I'm not very sure that is going to happen from the recent period that I've seen. I'm sure members in our group are going to have a different view, and that we will be happy to see that. Given this scenario, my conclusion and recommendation is that it's time. We are seeing green shoots in the economy. They should be permitted to grow and flourish. We should now decouple from the rest of the world and not worry too much about them, and encourage within our country growth. So I would say pause immediately. With that, I hand over the mic to Abhi to share his thoughts with Abhi.
Right. Thank you, Dr. Singh. I'll just be very brief and I'll start with my recommendation, which is for a pause, and I will try and justify this recommendation. I would have liked the RBI to move to a clearer stance, which is neutral, but I suspect that withdrawal of accommodation will continue. And that ultimately really refers to the way that they're managing liquidity, that they're not letting any liquidity surplus in terms of the banking system's net balances with the RBI build up over 1 lakh crores. So I think they have kind of revealed their liquidity management tactic somewhat clearly. And I think we should, banks have some degree of comfort that they will come in and provide liquidity if it falls really short. But on the other hand, there will not be an abundance of liquidity. But I think I would agree with you that given the global, the inflationary situation, which seems very comfortable, it is time for a prolonged pause. I think from the exchange rate perspective, where the interest rate does play a role, if the US debt ceiling talks had failed or had sort of gone into some kind of sort of a prolonged negotiation, then there could have been that we saw some flight to the dollar, and the dollar appreciated a lot. And if which was a manifestation of risk aversion in the system. I think with the resolution that risk has reduced. Risk is back. Risk preference is back on the table to some degree. So even from that perspective, we don't need an immediate increase in interest rates. But the other thing which is interesting and which might be sort of importance in the long term is that China has kind of disappointed in terms of its recovery. So for industrial commodities, including oil, the upside risks or the inflationary risks coming from commodities we can sort of assume them to have moderated a little. I still remain worried about the El Nino phenomena. It's in the rest of Asia. It has already sort of manifested itself in terms of extreme heat. They are now turning to large imports of agricultural commodities, so that remains a risk. I think that again, you mentioned the Fed. I think the Fed is going to hike rates just once, perhaps in July, and then it's sort of one and pause, perhaps not done, but certainly a pause. So given all this, I think a pause is warranted. And I think slowly we will see if things go on this track and we don't have a major event like an El Nino shock. I think the debate will slowly move to when rates are likely to be cut. I remember from last time, Indranil had a fairly strong view on when rates would be cut. I don't have that strong a view, but I would think that rate cuts will have to will have to start getting sort of will have to come center stage in the discourse and the discussion on monetary policy. I personally wouldn't recommend rate cut immediately. I think we need to sort of wait and see how things pan out for a bit. Central banks have made a bit of a mess last year. We don't want to sort of repeat our mistakes. But I think slowly, if things, ceteris paribus, if things don't change dramatically and some other risks pan out, we are going into a territory where I think in the next shadow MPC meeting, we will perhaps take up the issue of when rate cuts are due or are desirable. So that's where I stand. I just want to leave you with one bit of information from the banking side, and perhaps Siddhartha will expand on this, is that we've seen a lot of banks are talking about, you talked about the extremely positive and bullish, prints on the economic indicators, but there is some softness in credit offtake that has been there for about 6 months. And I think if you go down to the small size portfolios, both for retail customers as well as for the SMEs, there is a tentative sign of stress. It's not very major, but there seems to be some disconnect, which we bankers are now talking about, between the high frequency indicators as well as the headline macro numbers and the kind of not dramatic, but certainly noticeable, moderation in credit demand that we are seeing on a month-on-month basis. That's it from me. Thank you. And I apologize once again for having to leave early, but I have to get into a call with our MD. So, that's something I cannot avoid. Thank you very much. And thanks, Naveen, for letting me go first.
Thank you.
Avik, I totally agree with you. I didn't mention it, but there is a fear that with the interest rate cycle where it is, the stress on the commercial banks may start appearing. So I totally agree with that assessment of yours. And I'm little worried. I'm more worried on NBFCs. And that is where you brought in the MSMEs story. Thanks for bringing it in, which I missed. Thank you.
Right.
Indraneel?
Yeah, thank you, sir. So I think the RBI will be on pause and cut from October, 100 basis points from October. That is the base case. This assumes that the Fed pauses at 5/4. I think that growth will slow to about 5.5% in FY24. If you strip out the June number, growth is in any case, below 6%, even for the previous year. The June number was more a base issue than anything else. Inflation, again, we are expecting at 5.2%. So all in all, this makes, I think, a fairly strong case for RBI rate cuts from October, about 100 basis points. So you go down to around 5.5%. Two risks. Number one, of course, El Nino. If that happens, maybe the RBI, it's quite possible that if there is an El Nino, inflation will be about 200 basis points higher at least. And that may push RBI to wait till December, because then inflation is again back, above your 2 to 6% trajectory. And if you look at the Southern Oscillation Index, it is in double digits, -7 is El Nino. So the chances of a El Nino, a poor monsoon, I would think are fairly high. The second is that when I look at the Fed, inflation numbers in the US are still running 0.4 month on month, which means they are almost 5% on an annualized basis. So I have not seen any event in history where, inflation falls very massively without a positive real rate, so to speak. So whether the Fed will finally pause here, whether they hike later, is something that we need to see. We have a pause. I think today there are payrolls data. The market will then look at what is happening. As you know, the market had initially expected a cut in July. Now it's gone to December. There's a 70% probability of a hike in June now. So let's see what happens. Obviously, if the Fed were to hike, then the RBI will actually have to hike again. But then that, as of now, is not our base case. I mean, if the Fed goes to, let's say, 575, the RBI will have to hike at least once and postpone the cuts. But right now, our base case is that the RBI pauses till, till October. And I mean, it starts cutting from October, 100 basis points. Thank you.
Thank you, Indranil. Really, thank you bringing in the story of the Fed and the real rates. And of course, they're laying out throughout the year how El Nino will start playing. And I agree with you, El Nino impact would probably come at the later end of the year. Thanks. Let's move on to Siddharth now. Siddharth.
Sure, sir. Thank you very much. Thanks for this particular opportunity. Think about the upcoming policy next week, June. Looks like it's a foregone conclusion that it's a pause, not too much of a debate at this juncture. So that way, likely speaking, I may say it's possibly a slightly policy meeting this time compared to some more
just now.
Compared to some of the earlier occasions in recent months when their opinion used to be a lot more divided. So that way, in terms of the immediate policy measure in terms of the rates, we clearly expect that they stay on hold. Very clearly, inflation numbers, though there is an element of statistical effects, base effects, but still inflation numbers are significantly softer. We all do focus on the headline CPI number at 4.7%, but very interestingly, and my sense is that it's possibly these days we emphasize it doesn't get it's due the WPI inflation at negative 0.9%. That's also quite significant. Often we have seen some kind of a lead lag relationship eventually between WPI and CPI. So overall, at least in terms of the optics, in terms of the number, in terms of the reading, the inflation numbers seem to be pretty much under control. And if the RBI's numbers eventually turn into reality, the RBI's projections, that means we are talking about next 2 to 3 quarters. The inflation number will be averaging in the low 5% zone. So that's why in that kind of a situation, not only this particular round, the next few rounds also there may not be too much of a pressure on the RBI to act immediately on either direction. It's not that low that they immediately embark on a rate cutting trajectory. It's definitely not that high that they continue to build up further from the 6.5% repo rate that they have. So possibly we have come to that particular zone where we can think of a longer pause. I heard Indranil mentioning about an expectation of their expectation of starting of rate cutting cycle from as early as October. Our baseline assumptions that we pencil in is for a far longer pause. In terms of the stance of policy, Abhik mentioned it very clearly, and I think I tend to agree with him that we don't expect any change in the stance. There's a bit of a debate there that whether the withdrawal of liquidity continues or RBI moves to a neutral stance. But possibly talking about a neutral stance will mean that from this point onwards, interest rate can go in either direction. I think RBI may deliberately choose to stay behind the curve in terms of putting forward that particular communication. They don't lose anything in terms of delaying that particular communication, and they can just stick to their current stance of withdrawal of liquidity. And also, given that they are keeping the liquidity scenario under some kind of a check, not too much of a positive balance in the system, they can very well that particular stance can very well be justified. So our sense is that a pause followed, along with a unchanged stance is kind of the baseline scenario. I think what remains more than the RBI policy in this particular moment, what is more interesting to us is possibly the Fed policy, and more than the Fed policy action immediately, where we do think that there is a pause on the part of Fed also at this juncture. What is important is what is there in the Fed dot plot. We have seen the last dot plot about 3 months back in the month of March, when 11 out of 18 Fed governors spoken about, had mentioned about a possibility of just one more hike from that point onwards, which has eventually been delivered in April. And seemingly there is no immediate reason to believe that something has happened which can push some of them to opt for more rate hikes at this moment. So our baseline scenario is that at this juncture, Fed stays on a pause. The dot plot remains largely unchanged, or at least doesn't turn out, speak about a more hawkish picture. And in that case, that's our baseline scenario at this moment. Now, the joker in the pack is that what is happening with US recession. There had been a lot of discussion about a recession in US. I think the interesting fact remains that what is in store on that particular count in a quarter or 2 quarters down the line. If we get to see that the recession fears are increasing for whatever reason, then the Fed might actually be forced to take a slightly softer stance, which may not be the ideal situation for them, because for them the inflation rate is still pretty high. And ideally, from a central banker's point of view, the ideal scenario would have been to continue with a sideways interest rate trajectory for a slightly longer period of time. But if they are forced to cut, then possibly the chances of some other EMs, other countries, including India, considering a cut, that possibility goes higher. If that is not the case, and that is not our baseline scenario also, if that is not the case, then possibly US Fed, India, and so many other central banks stay on a slightly longer pause, and interest rate, the policy rates move sideways from here. So I think these are the major aspects that I wanted to highlight. And I think I can stop here, and later on, if there are any particular questions, happy to take that.
Thank you, Siddharth. This fear of recession in the US has really brought in so much of uncertainty. We really do not know how the payroll data is today going to tell us where they are heading to, but that could be also, I'm not sure, leading us somewhere. And you are right, 11 out of 18 state governors were seeking, I don't know if that has changed. But my worry is the debt ceiling debate that happened, and the way the debate in the Congress was so difficult, and the decision that they took of dividing the expenditure in defense and non-defense, so apparent that fiscal profligacy is going to be there. So in view of the fiscal profligacy, I do not know how the Fed is going to be viewing the situation. So thanks for that. Let's go to Arjun now. Arjun.
Thanks a lot, Professor, and thanks for the opportunity to everybody. So I'll just keep it short. 3, 4. So the last time we spoke, we were talking about how we were expecting a hawkish pause from the RBI. That seems to have played out. We continue to expect the same hawkishness from the RBI. So from an India point of view, in and around 5.5% inflation is what we're baking in, because we're expecting some sort of pressures from the monsoon. Midpoint of 625 on GDP is what we're looking at. The strength in the GDP numbers that we saw over yesterday, I think it is something to take note of, but it isn't really changing the trajectory quite significantly. So from an RBI point of view, we continue to harp on 2 points: how the Fed policy is extremely important, and the direction of the rupee. I think these 2 are the most important variables for us from an RBI monetary policy point of view. Inflation, we keep talking about how the RBI's narrative around inflation is more a narrative. These are the two main structural points that the RBI has a very close eye on. So our base case from an RBI and a global point of view is that we had a base case of no recession in the US in 2022. That seems to have played out. We continue to expect no recession in the US given how US macro indicators are holding up fairly well. So by around the end December quarter of 2023 is when we are expecting some sort of softness and earnings slowdown coming in the US that will eventually also reflect in the labor numbers. Currently, the situation in the US seems to be more of a labor hoarding because companies are still not very clear as to when the slowdown is actually going to start kicking in. So our base case is US growth softening around December quarter of this year. And as a result, March quarter of 2024 is when we're expecting softness in the Fed's narrative around rates, around monetary policy. Now, RBI, we expect the RBI to tag the Fed in this soft narrative in the March quarter of 2024, only if the rupee allows it to do so. So we've seen a significant amount of positivity around services exports. We don't really know whether it is structural as yet. Assuming it is not structural, then the trade deficit numbers that have actually come lower, it will have to remain at a sustainable pre-COVID sort of a level. If that does happen around the March quarter of 2024, then I think the possibility of the RBI tagging the Fed on monetary policy will be fairly elevated. So that's broadly how we are sort of looking at it. So the only risk, in a sense, that we see is this entire narrative. The last 2-3 days, you've seen a shift in the narrative from the Federal Reserve of a skip rather than a pause. So there was an expectation, an increasing expectation that the Fed will actually hike rates in the June policy. Now the narrative is more of how the Fed would skip rates in the June policy, and the markets are sort of building in a probability of a July hike. Now that's the only risk that we actually see, but our base case still remains that the Fed will remain at a continued pause all through 2023. So in short, from an RBI point of view, extended pause all through FY24. Possibility of rate cuts from the RBI only in the March quarter of 2024, provided the Fed eases in the same quarter and currency remains fairly comfortable for India. Yeah, that's it from my side.
So much. There has been an emergency at Mr. Bhalla's end. He has just logged off. And I just spoke to him and he said because of the emergency, he cannot stay any longer. So he has gone. But I must mention that Upasana Bhardwaj could not attend today. She has sent us her detailed scenario. Let me just tell what her views are. She's also, as you know, a member of our committee. Domestic inflation begins to inch lower and global monetary tightening cycle near its leg. We expect the RBI MPC to hold on to rates in the upcoming policy. So she's also recommending a pause. More so, the resilient growth as indicated by the higher than expected fourth quarter GDP also indicates that it should be a prolonged pause and not a pivot yet, at least through this year. So she's also looking at a prolonged pause. Further, with liquidity conditions having eased lately and the overnight rates again moving towards the lower end of the policy corridor, she sees RBI retaining its stance in this meeting. So the stance she thinks will continue. With this, the committee members' views have already been recorded. I would now like to invite, we have a guest from the industry, Mr. Shri Prithviraj Srinivas. He is the Chief Economist at Axis Capital Limited. I would invite him to share his views as our guest.
Thank you, Dr. Charan Singh, for this opportunity. So I would say I would sort of echo the views of what the members are saying broadly, that we will most likely see an extended pause from the RBI through this year. But I'd like to highlight a couple of data points. One, Dr. Charan Singh mentioned that, that unemployment rate has increased in April. But if you actually look at the data, you can actually see that labor force participation has improved. So what it really signifies is that a lot of the disgruntled workforce who had left the workplace is now sort of coming back into the job market. They're looking for jobs, possibly because rural wages are rising and also the opportunities are expanding. So it's actually signifying a positive element on the underlying domestic demand environment. The second aspect is on services. So we are looking at services exports being much larger than what it was pre-pandemic level, several billions of dollars. And we actually believe that this is an indication of much faster pace of urbanization, right? And you're also seeing that people who've got these jobs in the services sector over the last couple of years with 3 years of sort of income are most likely going to leverage on this income. And therefore, the pace of urbanization is going to pick up from here on. And to that effect, we think that we are going to see a cycle where when investments as well as net exports driven growth, what we're seeing today is going to broad base towards personal consumption as well, given that incomes are improving and financial conditions are also going to improve the coming quarters. So my sense is that RBI is going to face a scenario where inflation is broadly stable at around 5% for the next couple of months. Maybe it goes down to around 4.5%, but it comes back to about 5%. On the core inflation front, it will remain a little bit more sticky at about 5%, given the very strong services demand element there. But broadly, I think for the RBI, as it looks looks towards next 12 months, it's facing a scenario where demand growth is quite robust. It's being driven by investments, so capital requirement is going to be extremely strong. And therefore, you will start to see some sort of base level of inflation concerns, demand-led inflations creeping in towards the end of the year. So I would say that, purely looking at how the domestic cycle is sort of spanning out, an extended pause is what is called for. I'll stop here. I'll keep it brief and stop here. Sorry, I'm not able to hear you, Dr. Charan Singh, if you're speaking.
So I think you are on mute, sir.
I must thank you. I must thank you, Srinivas, for giving us your view from the industry. I totally agree with the view that you mentioned about the labor force participation. The data that I had from CMI for May end does show that the unemployment is down. If you look at the total, I don't have the rural-urban divide, but if you look at the total from 8.1 to 7.6. So the point that you are making, I totally take. And even looking at the high frequency indicators that were released on 31st March with the GDP data, they also show that there is a performance in the services sector which could improve labor absorption. And because the contact services are opening up, and that is where the GDP is showing so well in the Q4, I totally agree with you that unemployment figures would be downward looking in days ahead. So thanks for bringing that in. The services export story also, I totally agree with you, and I think that should be increasing. So with this, we have completed the complete coverage of the members and the guests. I would now invite if anyone from the audience wants to contribute. We have 10 minutes with us. We are happy to take a question if it is to any of the shadow members or the two guests, or just an observation that you would like to make. So it's totally open, please. Yeah, Mr. Sindhwani. We will requesting Mr. Ashwin Sindhwani, and then we will go to Deepak Agarwal.
Thank you, sir. Thanks for letting me join this August forum, and I totally agree with the viewpoint which has been expressed by most of the members, which practically we are saying either pause or extended pause. That's the only difference which I could pick it up. And the cut cycle starting maybe by October or the March 24. And some people mentioned about the liquidity conditions also. What I wanted to check it up, and I was expecting one of the members to at least comment upon that. The recent developments, especially on the currency market, especially with the discontinuation of the large high value currency notes in the domestic market, is that likely to have any impact on the liquidity in the domestic market conditions? And if yes, is that going to give some little bit more leeway to RBI in taking their position, taking their stance in the next monetary policy meeting? Is that going to have a bearing on the decisions?
Thank you so much. I think the very fact that nobody wanted to even touch or did not touch the rupees 2000 withdrawal shows that how insignificant that problem is. But I will request the members to reflect on it after we have covered Deepak Agarwal. Yeah, Deepak.
Yeah. Thanks for giving me this opportunity, Mr. Charan Singh and ASSOCHAM, for the valuable opinion. My point of view is like RBI shall go for the reduction of the repo rate to align with the G20, B20 conundrum of central bank policy, which is more driven towards 0 to 5%. The cost of capital is the biggest hindrance India is facing for the competitive global age. When we are talking about G20, B20, when we are talking about China plus policy, are we aligned to those conundrums which are the bottlenecks? It's the cost of capital, it's a inflationary, like driven by the banking cost, which is like almost double the cost of China plus. You take any G20 country, they are below 5%, even though they recently only increased the prices. We are at 6.5, and we are talking about pause or maybe, but the option is to reduce, to align with global averages, which is at 3%. We shall go and realign our repo rate for the competitive advantage, because MSMEs are falling prey to the cost of capital conundrum. We cannot have the survival, we cannot have the best of the growth ratio, because industry is looking forward to the cost of capital scenario, which is very, very compounding in nature, which is having a heavy burden. So we need to look at the greater aspects. If we are trying to be among the developed country, if we are trying to be the global source, if we are talking about the global south leadership, all global south leadership, which is 2/3, like India is now 1/5 of the population, and we are trying to the leader of like global south leadership. But how can we attain that if we don't have the cost advantage? We have all the resources in place, but we need to have the alignment with the cost advantage, which will give us the competitive edge. We have the resources, we have the technology, we have best of the brains working towards it.
Sure, we have
So
just 5
I will
minutes.
stop here. Thank you.
So thank you. We have just 5 minutes. Sorry, I had to cut you because we have just 5 minutes, and therefore let's give the opportunity to the members of the MPC, Shadow MPC. I would like to start with any of the questions you would like to take. Would like to start with Indraneel, then go to Siddharth, then go to Arjun. Any of the questions that have been raised, Indraneel, would you like to respond, or any other comment you want to make before we close? I think Indraneel, are you there? Siddharth, would you like to respond to any of the questions or have any comments?
No, yeah, sure. I think the first question, if we try to pick up that, what is the effect of the 2000 rupee note ban on liquidity? I think it's anybody's guess, but at the same time, if we do some kind of a very basic back of the envelope calculation, that the total quantum of 2000 rupee notes, the value is about 3,60,000 crore rupees. Now, it's fair to assume that more or less this entire amount will come back to the banking system, will be deposited to various banks over the course of the next few months, possibly in a reasonably front-loaded fashion. Instead of waiting for the 4th month, possibly we'll get to see that money coming to the banking system within the first 1 or 2 months, if not in the first month itself. Now, the question is, after it gets deposited in one's account as a deposit, how much money immediately and how much money over the course of the subsequent weeks or subsequent months gets withdrawn? I think that's the key question, and there is no clear answer to that. But even if we think that something like 25% or 30% kind of a money will eventually be staying back there, it will not be withdrawn immediately or in any near term. That means we are talking about close to something like 1 lakh crore kind of an additional infusion of liquidity from this particular, just 25% of the 3,62,000 crore amount that we are talking about. So we are talking about something like a 1 lakh crore kind of additional infusion. Also, around this time, we will be seeing in the month of June the infusion of liquidity from RBI's dividend payment to the government, which has also been sizable this time, slightly higher than a lot of people's expectation of 87,000 crore. So these two factors will provide an immediate fillip or relief or cushion to the liquidity situation. And in fact, this is an important point that actually is connected with my expectation of them not changing the stance, not lowering the hawkishness or at least caution, if not hawkishness, in terms of their guidance and commentary. I think these two things are related. Even if rates are on pause, given that liquidity in the immediate term there's a bit of infusion, RBI might actually prefer to continue sounding a bit stern. That's point number one. And very quickly, 30 seconds, if I can take on Mr. Agarwal's point on interest rate reduction for the benefit of MSMEs. I do have usually a lot of sympathy for this particular point. Now the question, and this is something I had been arguing for a fairly long period of time in this particular forum also, that whether we should continue hiking the interest rates. To be very honest, even before April, I was expecting a pause a little earlier. But having said that, now, right or wrong, the interest rates have come here. Is it a great idea on the part of monetary policy to do a very quick and sharp U-turns? I may not really vote for that particular thing. Rather wait a bit, see what is the impact, and there are monetary policy is not the only way to boost competitiveness in an economy, especially when the global situation and some of the other situations are also fairly volatile. I'll not be in favor of too many changes too quickly, and that too in opposing directions in monetary policy. Rather, now we have reached here, we'll go a little slow, see after a few months how exactly we need to go ahead and decide. I'll stop here. Sorry for taking a bit long.
Thank you, Siddharth. Arjun, would you like to react to any of these questions or have your new comments on any of the things?
Just one small point on the 2000 rupee note ban. So I completely agree with what Siddharth was talking about. So, but one small bit on, at least from a market impact point of view, I think 5 to 8 basis points is broadly the range in which yields can come down by, if at all of it actually gets deposited to a large extent. Now, the impact will also depend on what one's assumption is from how much of a cash economy we are in, and how much of this money is under the tax umbrella or not under the tax umbrella. So there are quite a number of assumptions here. But from a market point of view, I think purely this is not very significant. And from a yield point of view, the 4 variables that will continue to remain very relevant for India 10-year yields to move lower will be crude, rupee, domestic liquidity, and inflation, in that order of importance. Yeah, that would be it from my side.
Thank you. Indranil, are you there? Okay. So my own personal, Indranil, would you like to react to any of the questions that were raised or any additional point you would like to make at this stage?
So one was the 2000 note, and what was the other one? I'm sorry.
The other was, why don't we align our rates with the G20 and other countries? Why are we holding it at 6 point something, whereas mostly it is around 3% for other countries. Because we misalign, there's a situation which gets very complicated in our country. And of course, the ones who suffer the most are the MSMEs.
So, coming to the second one first, if you look at most countries, advanced countries, their growth rate is like 1.5 to 2%. Inflation is somewhere around 2%. So their rates are lower. In India, potential growth is about 6%. Inflation is 5 to 6%. So therefore, obviously our rates have to be higher. It's not, I mean, you cannot align with countries which are in a completely different, cycle than we are. Coming to the 2000 rupee note, I would say that, there are three categories of people. One could be those who will suddenly discover they had some 2000 rupee notes lying around. There could be those who hold it for precautionary demand or transactions demand, and there could be those who were stashing black money. Now, I would imagine that very few people here, and we found that out during Demon, that in a high inflation country, why would anybody hold very large sums of money in cash? You can buy gold, you can buy land, you can do so many things. So and as we found out then, people who may have had black money in cash had no problem whitening it. People who hold it because they want to transact, or whether if they want to keep a certain amount at home, they are going to go and exchange. If I decide that I want to keep 10,000 rupees at home, I'm going to get that 10,000. If I may deposit the 2,000 rupee notes, but I'll get the rest back. So I think that the only impact that the system can have is if someone suddenly discovers, oh my God, I had these 2,000 rupee note, which I did not deposit. So I think that the impact therefore is not going to be much.
So then I think with this we'll conclude. I also feel the same thing, what Indranil mentioned and others, that we cannot align with these countries because they're in a very different state. We are in a different one. And the 2000 rupee note to me is not going to create any major impact. As far as the conclusion of our today's meeting is, I believe that the overall view is the pause. How long the pause will last, we'll have to see. The second view is the American economy, lots of uncertainty. We are not sure when the rate cut cycle will start. Would it start before October, November, or would it shift to March, April of the next year? We will have to wait and watch. Given this completely uncertain situation that we are in, the Reserve Bank certainly has a difficult course to follow. But given the green shoots in the economy, the feeling of the shadow MPC and the two guests is that there should be a pause immediately, and later one can assess the situation and see what to do. With this, let me conclude, and I want to just check with Dr. Rajesh. Does somebody want to do a vote of thanks, or can I just conclude?
I think I request Vasudev sir. Vasudev sir, can you deliver vote of thanks, please?
Thank you. On behalf of ASSOCHAM, let me thank EGROW Foundation for partnering with us. Dr. Singh, it was a pleasure hearing you as always. And I would like to thank all our panelists for sharing their views with us. We will, of course, take all of this into consideration and finalize our recommendations to the RBI, which we will be sending in very shortly. So thank you very much for joining us this afternoon, and we look forward to having you again for the next convening of this council. Thank you.
Thank you, everyone. Thank you.